Hey everyone, today I'm going to cover the different inventory methods that you will see in an introductory financial accounting course. We're going to go over the two methods called FIFO and LIFO. So FIFO stands for first in, first out, and LIFO stands for last in, first out. So each company individually can choose which method they would like to use. There are some tax implications regarding these, so make sure to review your textbook if you want to go into the details of why a company would choose FIFO over LIFO. So I'm not going to go into the theory behind it today. I'm just going to help you work through a problem so that you know how to tackle these types of problems in your financial accounting course. So the textbook that I use in my courses is the Corporate Financial Accounting, 16th edition by Warren. It is put out by Cengage, so if you have a different textbook, you want to review what your textbook is covering regarding these particular topics. But FIFO and LIFO doesn't vary by textbook, so you shouldn't have an issue with this. So I'm just going to cover this, just the generalizations of FIFO and LIFO, like I said, the inventory methods. So let's go ahead and get started. So I have a problem that I've set up here, and I've also set up a FIFO LIFO form in Excel. Excel is a great tool for this because you can do your calculations in Excel as you're going along. But you can always set this up on paper. It's just good to have something like this to keep track of your inventory as you're going along. Like I said, the amounts that you input in these particular columns is going to depend on which method you're using, but you can use this form for FIFO and for LIFO. So, and also weighted average. But I'm just going to pay attention to those two types of methods today. So the first column is for purchases. The second column is for your cost of merchandise sold. And then finally for inventory. So your answers to these types of problems are going to depend on what the actual question is looking for. So make sure to pay attention. So my problem here, I have different types of transactions that are going on through the month of January. And then it says there are 24 units of the item on hand at the end of the year, and we're using the perpetual inventory system. So if they're asking for the periodic inventory system, this type of problem would not apply. So you want to make sure to cover the rules for your periodic inventory system also. So part A, they want the total cost of the ending inventory according to FIFO, and then also the cost of goods sold according to FIFO, and then ending inventory according to LIFO, and cost of goods sold according to LIFO. So let's go ahead and get started with this problem. So the first transaction on 1/1, they had beginning inventory of 20 units at $46. So I'm going to go ahead and put that into my Excel sheet over here. So my date is 1/1, and I have beginning inventory. So there's no purchases, no cost of merchandise sold. It's just inventory that is sitting in their warehouse at the beginning of the year. So you need to keep track of this because every time you sell a product, you're going to pull it out of your inventory. And the cost that you're going to use depends on what type of inventory method you're using, FIFO or LIFO. Again, FIFO is first in, first out, which is what we're going to cover here. So, we had 20 units. It cost us $46 per unit. So my total cost, I'm just going to multiply my 20 by 46, and it has a total cost of $920 for our beginning inventory. That's the amount that's going to be shown on the balance sheet. Then we made a sale on January 10th. So according to first in, first out, means the first units you brought in are going to be the first ones that were sold. We only have one inventory cost layer here, so we're going to pull all of those 12 units out of our 20 units that cost us $46. So I'm going to go ahead and sell my 12 units. It cost me $46 per unit. And so just multiply those out, the 12 times 46. All right, so I sold 12 units. So my ending inventory started at 20. So I'm going to do equals 20. And then I went ahead and sold 12. So I have 8 units of inventory left over after I sold those 12 units. Again, they cost me $46 per unit. So just multiply out the 8 units of remaining inventory times the cost of the individual inventory. So I have a total cost of my ending inventory now of $368. And the cost of the goods that I sold for this on this date of January 10th is $552. All right, now on 115, I made a purchase now of 33 units. That cost me $49 per unit for a total cost of the 33 times 49 of $1,617. So now when I go to put my ending inventory together, I can't just merely take 8 plus 33 because that's not, they don't have the same cost levels. You see these 8 units cost me $46, but these 33 units cost me $49. So I need to go ahead and keep those separate because when I make a sale, I'm going to sell my first ones that I brought in. They're going to be the first ones sold. So first in, first out. So that's why I need to keep my inventory layers separate. So I'm going to go ahead and pull down the 46 units that or the 8 units that I have at that cost me $46. So that costs total of $368. So I'm merely pulling this amount down. So on January 15th, I still have those 8 units because I did not sell those. But now I also have 33 new units that cost me $49 a piece for a total cost of that $1,617. So if I were asked the question, what is the total value of my ending inventory at the end of January 15th? It would be that $368 plus the $1,617. That would be the total cost of my ending inventory at the end of January 15th. Again, we have to keep these cost layers separate because when we go to make a sale, if we're using first in, first out, we're going to sell all of these units before we sell any of these units. And the reason why that's important is because they had different costs to us. And that's the amount we're going to show on our income statement as our cost of goods sold. So that's why that's important to keep those separate. All right, so we're done with the January 15th purchase. We're going to go ahead and record the January 16th sale. So we sold 24 units. I can't just put 24 units here like I just put the 12 up here because we're using first in, first out. So the first thing I need to do is sell all of those 8 units because we sold 24 total. So those cost me $46 a unit for a total cost of $368. And then we're going to go ahead and sell the remaining units take that out of these 33 units here. So we sold a total cost, or not a total cost, a total number of 24 units. We've already accounted for 8 of those. So 16 remaining units are going to come out of this $49 right here. All right, so take your 16, multiply it by 49. And that's cost us $784. So a lot of students will want to put this $71 in here. That goes on your journal entries. That will not go on this costing sheet here. On this sheet, we're merely trying to figure out our ending inventory and cost of goods sold. So don't put that $71 anywhere on this form. It will go in your journal entries on the sale. So now we've accounted, we sold 24 units. 8 of those units were costing at $46 and the remaining 16 units were costing at $49. So if I had to get my total cost of goods sold for this particular sale on the 16th, I would add up my $368 plus $784. You see, we can't just cost those at one level here because we're using first in, first out. So we got rid of all of these 8 units. So when I go to put my ending inventory, I no longer have these $46 units right here. What I do have is I started with 33 units of these $49 units. I sold 16 of them. So I have 17 of those units left. They cost me $49 each. So take your 17 and multiply it by 49. And I have a final ending inventory value at the end of January 16th of $833. All right, let's go on to the 20th purchase. So I purchased another 30 units, cost me $51 each, for a total cost of 30 times 51 of $1,530. So my ending inventory now, I have 17 units still left of the $49 per units there, units. And then I have 30 units of the $51 units. So I'm going to go ahead and put that in my totals here. So I have 17 units that cost me $49 each for a total of $833. And I now have 30 new units that cost me $51 each for a total cost of $1,530. So if you were asked the question, what's the value of your ending inventory at the end of January 20th? It would be the $833 plus the $1,530. That's the total cost of your ending inventory. All right, the last transaction on January 29th, we made a sale. Again, we're using first in, first out. So I have to sell all of these units before I can sell these $51 units. So I need to sell my $49 units first before I take it out of here. So I sold 23 units. So I'm going to go ahead and sell all of these units here because I only have 17 units remaining of the $49 units. So I'm going to go ahead and sell all of those. Get rid of all of that off of my books. And then I sold a total of 23 units. I've already accounted for 17 of those units. So I need to account for 6 units remaining. Again, it cost me $51 each because I'm taking out of this layer right here. So go ahead and multiply it out. All right, so the total cost of goods sold for the January 29th sale is your $833 plus your $306. So when you go to put that in your journal entry, that's the amount you're going to use for cost of goods sold. All right, now my ending inventory. So I sold all of these $49 units, so I don't have any of these left, but I do have some of my $51 units left. So I'm going to take my 30 units that I started with, subtract out the 6 that I sold. So I still have 24 units of the $51 units remaining for a total cost of $1,224. So if I go to the end of the month and they want to know what is the total cost of the ending inventory according to FIFO. So I'm trying to answer A and B here. And yes, I had to do all of this in order to answer A and B. So the ending inventory value is merely your $1,224 because I only have one cost layer left according to FIFO. So I only have the 24 units left at $51 per unit for a total cost of $1,224. If I wanted the cost of goods sold for the entire month of January, so what's the total cost of goods sold according to FIFO? I'm going to add up my entire column of cost of goods sold. And I have a total cost of goods sold for the month of January of $2,843. So my ending inventory value in part A would be $1,224. It's merely what is remaining at the end of the month. If I want the total cost of goods sold for the entire month of January, I would add up my total cost column right here. All right, let's look at LIFO now. So we're going to do the same problem, same transactions, but now the company has chosen to use LIFO. So I've left these transactions here because it's not going to differ up until we get to this sale on the 16th because my cost layers aren't going to change because when I made this sale here, I only had one cost layer to worry about. It's not until I get to this 15th transaction when I'm adding on these extra 33 units that's going to change my sale on the 16th. So that's why I've left all of this up here for the beginning. But now we're using LIFO. LIFO means last in, first out. So that means the last units that I brought in are going to be the first ones that I sell. All right, so let's go ahead and record on January 16th this sale. So according to LIFO, again, last in, first out. On the 16th, I sold 24 units. I have enough of these last units to absorb all of those 24 units. So I still have 8 units remaining at $46 and I have 33 units at $49. Last in, first out means I'm going to sell these $49 units before I get into this $46 cost layer. So I only sold 24 units on the 16th. So all of these 24 units can come out of this $49 cost layer. So I'm going to go ahead and put that in here. Multiply out my 24 times my $49 cost layer. Cost me $1,100 and $11.76. Sorry, I can't talk today. So when I go to calculate my ending inventory, I still have all of these $46 units. So I have all of the 8 units that cost me $46, because again, it's last in, first out, for a total cost of $368. Now when I go to calculate my $49 units, I've already sold some of these. So take your 33 that you started with, subtract out the units that you sold. And I still have 9 units remaining out of these $49 units. So go ahead and calculate your ending inventory value. Take your 9 times your 49. So cost me $441. So in my ending inventory at the end of January 16th, I have $368 plus $441. So you can see how it changes between the FIFO and the LIFO method at this stage. All right, then go ahead and put your January 20th sale in, or purchase in here. 30 units, that cost us $51 per unit. So 30 times 51 for a total cost of $1,530. In my ending inventory now, I'm going to have 3 cost layers according to the LIFO method. I still have all of these $46 units, so 8 units times 46. I have the 9 at $49. And now I also have 30 at $51. So I'm going to go ahead and put in my values. 8 times 46 gives me the 368. Then I also have all of those $49 units, so 9 at 49 equals 441. And now I have these new units here, so I'm just going to go ahead and put those in here. Oops. Equals, let me do the actual proper formula. So you can see where I'm pulling these from. So I have 3 cost layers. My formatting is a little funky, but just bear with me. 8 times $46 gives me the $368. 9 units times $49 is the $441. And now I have these new 30 units that cost me $51, and for a total of $1,530. So if I wanted the value of the ending inventory at the end of January 20th, it would be your $368 plus $441 plus $1,530. All right, when I make my sale on the 29th, again, we're using last in, first out. So I sold a total of 23 units, and I'm going to sell them from the last ones that I purchased first. So I purchased 30 units was the last amount that I purchased. So all of those 23 units can come from this $51 cost layer. So multiply these out, take the 23 times 51. So when I go to calculate my ending inventory, I still have all of these $46 units. So go ahead and pull down your numbers. 8 times 46 is our $368. I didn't sell any of these $49 units either with my last sale on the 29th. So go ahead and pull down those. But I did sell some of these $51 units. So the amount I sold, I started with 30. Subtract out the 23 that you sold, and I have 7 remaining. That cost me $51 for a total cost of 7 times 51. Total cost of $357. So when I go to answer my question here in part C, what is the total cost of ending inventory according to LIFO? That would be the amount that you have remaining at the end of the month. So I have $368 of my $46 units. I have $441 total dollars of my $49 units. And then I have $357 of my $51 units. So my total value of my ending inventory at the end of January is $1166, and that is the answer to part C. In part D, what is the total cost of goods sold according to LIFO? They're wanting for the entire month. I'm going to go ahead and sum it up. It'll be $29.01 according to LIFO. So if they were just asking what is your cost of goods sold for January 16th, it would just be this $1166. If they were asking what it is for January 29th, it'd be $1173. So it all depends on what the actual question is asking for. If you're asking to do it and then put it in a journal entry, your cost of goods sold for January 29th would be a debit to your cost of goods sold for the $1173. And then a credit to inventory for $1173. So that's how you get the numbers that go into your cost of goods sold journal entry. So the reason why we have to do this is to keep these all separate, because if you remember FIFO and LIFO, we end up with differing ending inventory values versus cost of goods sold for the month. You can see how it changes. In a period of rising costs, your LIFO will always give you a higher cost of goods sold and a lower value of ending inventory. It's because your costs are going up in inflation time, like we are having now, where costs are consistently rising. Your cost of goods sold will always be higher using LIFO because we're selling these newer ones that we're bringing in first. And if your costs are going up, obviously this number will be higher than this number. You can see it illustrated in this particular problem. So the reason why a company would choose to use LIFO versus FIFO is because if they have a higher cost of goods sold, that means more expenses, which shows less income. Therefore, you pay less taxes. So if you're showing less income, you pay less taxes. If you use FIFO, your tax bill might be a little higher, but you're showing higher net income, which maybe looks better to your investors. So it all depends on what the goal is of your company. Do you want to show a higher net income and show like you're more stable to your investors, or do you want to show a lower net income, pay less taxes, which could be better in the long run? So there's just different goals. So each company can choose which method they would like to use. If a weighted average is somewhere in the middle of this, so they're weighting the numbers as you're going along. So that is it for the FIFO LIFO illustration problem. The journal entries related to this problem I had already put up there, like there's the buyer and seller entries. There's a video related to that. So if you're ever asked to calculate the amount that goes into the cost of goods sold, you can use a sheet like this that I have set up in Excel. It's really easy to set up something like this, and that way you have something you can practice on. You can print them out so you can write it down as you're going along too, but this way you can just, delete and do your calculations in the sheet, so it makes it a lot easier. All right, so if you enjoyed this video, comment below. And if you'd like to see any other specific videos for accounting, just let me know and I can set that up. If you subscribe to the channel, you get the latest updates. Like I said, as you go throughout your accounting career, I will be adding videos to help you with tax, cost accounting. So I'm going to be constantly updating my channel here soon. So happy studying, and I hope you all enjoyed the video.